Good evening. My name is Vijay. I'm also popularly called as Sainik. I've been in the market for more than 30 years prior to Harshad Mehta's advent into the markets. I have seen the ups and downs since 1990s, and with God's grace, I've survived. So I've started this channel called Market Mirror. Here, I'm planning to discuss on a day to day basis the ups and downs of the markets twice a day. Once before the market opens, the pre market session, and then one the post closing session, which I would call it the post mortem. I would also like to conduct, I would also like to talk about the markets in general on a weekly basis. So this is my first amateurish attempt to try to give my ideas about the markets in general, and where are they going in the future. So I thought this is a very auspicious time, or rather very relevant time, for us to talk about the markets, especially as per my analysis, it shows that the following week, the week beginning tomorrow, could be the harbinger of extreme volatility, which we have seen about four times in the past. So before we go into why I think there will be great amount of volatility, a little bit of history. See, there was this big bull run in 1991, 92, and then there was a big crash and there was great amount of volatility in the Indian markets. That was called the Harshad Mehta bull run. Then there was another such a volatile time, which was between 99 and 2000, which was called the dot-com boom and the crash. We also had a significant volatility in 2005 and 6, where in 2006, in 1 month, in Nifty lost about 25%. We had a rally in 2007 and subsequent volatile movement downwards in 2008, which was called the global financial crisis. Subsequently, we've had volatile years in 2015 16. We've had another one in 17 18, and then, of course, the COVID volatility, which was there in 2020. What we are going to see in 2023 24 is probably going to equal that kind of volatility which we have seen in the past 30 years, and maybe much more than that. Now, I do not want to scare any of you to think that volatile markets means only downwards and we do not have opportunities. My personal experience has been that whenever the markets are volatile, they throw up fantastic opportunities for us to get into sectors and stay in those sectors to make money in the next cycle whenever it comes. So at the very outset, I'm actually looking forward to this week and following weeks when I expect great amount of volatility, and I'm hoping that I will be able to identify those sectors which I will detail over the next few weeks as to what those sectors and what stocks are there. But for today, we should focus on why one should think that we'll have a volatile 24 after having a relatively smooth 2023 when globally markets were bullish. As we enter the month of March, typically volatility increases primarily because of liquidity coming down across the globe. It is not only limited to India. Now, especially so this year, the volatility will increase simply because whatever the Fed had done last year, the BTFP program is ending on Monday. And the first of the loans which were taken between March 14th and April 15th of last year have to be returned by those banks. Now, that will suck out a lot of liquidity from the system in the US. Similarly, in India, for instance, March is one of the worst months for liquidity simply because all tax planning is done during this month at the individual level. At the corporate level, you need to pay advance taxes, and that sucks in a lot of liquidity. You also have the operators or the large investors who close their books of accounts in the month of March to reopen them in month of April. So traditionally, March 15th onwards, you will see a drawdown in terms of liquidity, therefore affecting the stock prices. So there is nothing to be surprised that if we observe it this year. Now, there is another issue which is there this year, which is very different from what has happened in the previous years. What we are seeing in the last 1 year has been the Fed's relentless increase in interest rates, or at least now in the last few months, the reluctance to reduce interest rates. The market has been anticipating that Fed will reduce interest rates. Last year, they anticipated in January, now in March, but it looks like the Fed will come into action only under two circumstances. One is if interest rates, if inflation falls down significantly, or if there is a market crisis. Right now, the inflation data doesn't suggest that there is any drastic drop in inflation going forward. So the only way Fed can come and reduce interest rates in our analysis is that if there is a significant market drop. Now, we do not know whether we'll have a significant market drop, but we can guess that there will be significant market volatility. Now, if you talk about the reduction in liquidity, it is not only limited to U.S. Fed. It's also in terms of liquidity going into areas like Bitcoin, for instance, or some other activities which are not conducive to, let's say, the growth in the capital market. Now, what people have forgotten is that gold is one repository where the central bankers have been accumulating gold since the last 2 years. Many people may be amazed when, if I would give you a data point which says that the accumulation of gold by central banks through their sovereign funds in the year 2022 has been the highest ever since records were maintained in 1951. So we have had nearly 75 years of record maintenance, and we are seeing that what we saw in 2022 was the highest. 2023 was no different. 2024 is unlikely to be any different. So you have very big buyers of gold, and they have no intention to trade in this based on the prices. Now there are very, very few people following the gold markets. So much so that gold was considered a dead relic. Last few weeks, gold has gotten up from its sleep. And whenever gold has gotten up from its sleep, typically the gold rally goes some 6 to 7 times from the bottom. So if you consider the bottom of 1840, which we saw a few months ago, then you can well imagine where gold can go in the next 6 to 7 years. So that is what one should look at. Now that will suck up a lot of other liquidity which is now prevailing in the system. You have liquidity going into Bitcoin and cryptocurrencies. Now it will go into precious metals and commodities. Because the commodity universe, we are seeing in copper, zinc, titanium, lead, slowly and steadily they're forming bases. And the base formation, once it's completed, then you can expect a rally into the next few weeks to months. So liquidity will drop down there. Then the bond markets also, there is a possibility of liquidity getting into bonds. So all said and done, risk assets are likely to have some pressure, headwinds, which will not only be in the month of March, which will be there for the entire year. Traditionally, if you look at the Indian markets follow the global markets. What is happening in the global markets is reflected in the Indian markets. So what we saw on Friday, for instance, was an all-time high here, so much so in the US markets. But what we saw on Friday closing was a tremendous volatility, especially led by Nvidia, which is the poster boy of this manic bull market. It lost about $128 billion within a span of 1 hour. $128 billion, to put it in perspective, is about half the market cap of Reliance. So half of market cap of Reliance has been lost in just 1 hour. So you can imagine the kind of positioning which was done, which was kept in Nvidia, what would have happened to those positions. And that, I think, will get reflected in the next week. Next week also, you have the Bank of Japan, somewhere on the next Monday actually, Bank of Japan meeting to change their ultra easy money policy. If they do that, that will further suck up the liquidity. Locally, RBI is warning banks that they have put liquidity into the market willy-nilly through indirect means. So that also will make the banks and the NBFCs to take out money from the market in an indirect manner. So all said and done, I believe that we have turned the corner as far as easy liquidity goes, and barring and catastrophic moves in the market, none of the central bankers are wanting to increase liquidity. The QT on one hand, the quantitative tightening is going on, and that will continue till liquidity gets sucked in the reverse repo market in the US. So all said and done, you will have a liquidity tightening in the next few months. Let's look at also geopolitical issue. There was a talk of a ceasefire in the between Israel and the Hamas people, but that has not materialized because they were looking at a ceasefire before Ramzan, and Ramzan is starting now. So the concept, the chance of a ceasefire is out. And in India, we also have the elections coming up. During elections, generally liquidity dries up in the from the risk assets. So that is another blow to easy money which was there till now. So what I'm suggesting here is that there is nothing to fear in volatility. Volatility should be considered as our friend. I have myself participated in volatility in the last so many volatile years since 1990s, and we have seen that you get some fantastic bargains which we should look for. Now, if you look at volatility, volatility is something like your monsoons. So today, now the summer of liquidity is getting dry, and now you are going to get into a winter, and volatility is like the monsoons. So in monsoons, you should not worry, or you should not feel that monsoons will wipe away all the gains. It may wipe out, but if you have the adequate raincoats and umbrellas, then I think you will survive the monsoons. And please remember that after monsoons and winter, then the spring comes back again. It is just one more cycle. So I don't think one should worry about any volatility. Only one thing one should do is to protect ourselves and not go berserk as what most people might have done in the last 6 to 8 months. The time for caution is here. The time for taking care of whatever returns we have, to book those returns, and then keep cash in hand for the inevitable drop in stocks across the board in the next few weeks. Now, I would like to caution here that I am not a SEBI registered analyst. These are my thoughts based on my experience of last 30 plus years, and I am putting my money where my mouth is. So while I'm fully invested, I'm also taking hedges to take care of any volatility which is arising. We are also, as a family office fund, we are also invested in precious metals for us to take advantage of the impending global gold and silver rally is as per what we are seeing today. Incidentally, gold has made an all-time high and nobody seems to have noticed it, while silver has not yet done. So please take my prediction and commentary in the right perspective. This is for educational purposes. This is not an investment advice. People who listen to this, please consult your investment advisor before jumping into any asset classes which I'm mentioning here. I hope this has been useful. I will come back, as I said, every day, morning and evening, on all trading days, to give you a status check on what's happening in the market. People have been following me on Twitter. People have been following me on Telegram. On Telegram, I run this same name channel called Market Mirror. On Twitter, my ID is at Synic636. So you will get information there. But I will also come here and update you on a daily basis. Thank you for listening. Thank you.